Topic 4.
Good morning, sir. My name is Dimple Pipacaul from BSBA OM2H. So today, I'm going to discuss the debt utilization or leverage ratio. When we say debt utilization leverage ratio, it is the leverage ratios allows to analyze to ascertain how efficient the company manages its financial obligations. Under this, you need to compare the liabilities and owner's equity via CV's total assets or total liabilities and owner's equity. Next is, the owner's equity is considered as the margin of safety by the creditors. This is because the owner's equity is the amount that can absorb any decline in asset. In other words, in case the assets of the company decline, the owner's equity is the amount that can be used to pay the creditors. So, number 1, debt to equity ratio. This is the formula. Total liabilities divide total stockholders' equity. So, di-divide lang, then after nun, yun na po yung answer. So, ito na po. The use of borrowed fund in carrying out the firm's operation is called trade on equity. This means that firms is willing to borrow money and pay fixed interest charges from the loan. The borrowed money will be used to increase volume of operation and ultimately earn more profit. Next, this is an example of financial leverage. When a firm borrows funds to be used in the businesses, the total asset or cash and total liabilities or bank loan of the company increase. However, the owner's equity remains the same. Its profits increase. The trading on equity or use of borrowed money would increase the debt or equity ratio of return on owner's equity. The debt or equity ratio presents the firm's capital structure and the inherent risk. The liabilities of the company present a risk and blessing or benefit on the part of the owners. It is a risk because if the company fails to use the borrowed money wisely to improve operation, the interest expense from their borrowings will be higher than their operating income or operating loss. It is also a blessing if the company is able to use the money wisely to improve operation, leading to higher income. And the higher income ultimately increase owner's equity. The high income exceed the interest expense from the borrowing thus, making liabilities a blessing for the company. This structure indicates the trade-off between risk and return. The debt or equity ratio goes the amount of risk involving firm's capital structure insofar as the relationship of funds provided by the creditors or liabilities the owners are concerned. The higher the ratio, the riskier the capital structure. Real's debt and equity ratio is 144%, present a high risk in the firm's capital structure. Management should be mindful of the efficient use of the company borrowing in improving operations to ensure higher yields. Number 2, debt ratio. The formula of debt ratio is total liabilities divide total asset. The ratio could be interpreted to mean that for every 1 peso asset of the company, 0.59 was borrowed or was provided by the creditors. It basically presents the proportion of borrowings to total assets. Generally, As explained earlier, the higher the debt proportion, the higher is the risk. In addition to this, the risk is higher because if the firm gets bankrupt, the creditors must pay first. If the assets are not sufficient to pay all the debts, the owners will end up with nothing. Real's debt ratio is 59%, present a relatively high risk on the part of the company. Management should be mindful of the risk from borrowings. In addition to this, the ratio may bring about some difficulty on the part of management to borrow when they need it. Low owners' equity structure decrease the margin of the safety for creditors. Number 3. Number of times interest earned. The formula of this is net income before interest and income tax or operating income divide annual interest expense. This ratio indicates the ability of the firm to pay fixed interest charges. It gauges the company's ability to protect long-term creditors. Real's times interest earned of 5.26 times indicates that the firm is very much capable of paying its fixed interest charges from its operating income.
Topic 2. Objectives and limitation of financial statements analysis. Fundamentally, analysis of financial statements are set to answer a wide range of questions of users. These users have diverse concerns and objectives, hence, they have different priorities. However, all these users have common requirements where the very objective of financial statements analysis originates. The analysis then aims to prove the company's profitability, liquidity, and stability, asset utilization or activity, and debt utilization or leverage. The primary purpose of financial statement is to exclusive the present as well as past financial position, SPF, and result of operation, income statement. Income statements of the firm in order to determine the best suitable statement and predict the future state and performance of the company. With this in mind, it would be fair to state the interpretation of financial ratios are not ultimate conclusive. Financial statements are important because they contain significant information about a company's financial health. Financial statements help the companies make informed decisions since they highlight which areas of the companies provide the best ROI, return on investment. This view as to the useful of financial statement for management evaluations involve no significant national exceptions, and for analysis, investors, and other users, financial statements are more useful for management evaluation than for hold and buy-sell decision or credit assessment. Company management. The management teams need to understand the profitability, liquidity, and cash flow of the organization every month so that it can make operational and financing decisions about the business. Ratios analysis and its effect in decision making. When we say ratios, present relationship between two variables. Financial ratios refer to the relationship between financial statement items or account expressed in mathematical fashion. In use Using these ratios, your task is to interpret them as favorable or unfavorable. To do so, you should follow some standards that would determine the favorableness or unfavorableness of the outcome. Some of the standard ratios used are based on: number 1, company budget for the same period; number 2, those used by the industry to which the firm belongs; number 3, those used by the firm's successful competitors; number 4, those used by the firm using prior periods; and number 5, those used by the analysis in the past. Industry ratios are average developed by a group of experts involved in research. These empirically based ratios are used as standards in financial statement analysis. Industry ratios are averages developed by a group of experts involved in research. These empirical-based ratios are used as standards in financial analysis. Industry have their own peculiarities, hence, expert-developed ratios that are suitable for the industry. Since this task is to deduce analysis, resorts to using ratios of competitors which are readily available. There should be consistency in the computation as well as usage of ratios to ensure comparability between results and prevent their misinterpretations. Just like any financial analysis technique, financial ratios are subject to limitation. Results from financial ratios analysis are indicators of a firm's weaknesses or strength but are not in themselves good or bad. This is understandable since the ratios spring forth from financial statement, which, as we have mentioned, are subject to limitation.
Good evening, sir. My topic is all about tools in comparative financial statement analysis. Financial statements are reports that summarize important financial accounting information about your business. It also provides information about the organization's past performance, present condition, future performance. And there are three main types of financial statements: the balance sheet, income statement, and cash flow statement. These three major financial statement reports shows to have complete information regarding assets, liabilities, equity, reserves, expenses, and profit and loss of an enterprise. Here's an example of balance sheet, income statement, and cash flow statement. This is the interested parties: management, employees, creditors, lenders and investors, shareholders, labor unions, and government agencies. They use the financial statements because they want to evaluate a company's financial health and earnings potential. And also, they rely on financial data to analyze the performance of a company and make predictions about its future direction of the company's stock price. Comparative statements. It is also called as horizontal analysis. It shows the financial position of the company at different time periods. It is one of the tools of comparative financial statement analysis. Here is an example of horizontal analysis. Assume that the management of UD Corporation Ltd. provides you with comparative balance sheets of the years ended December 31, 2014 and 2013. Management asked you to prepare a horizontal analysis on the information. Using comparative financial statements to calculate monetary or percentage changes in a financial statement item from one period to the next. Calculating change in monetary amounts. The formula is monetary change is equal to current year figure minus base year figure. Since we are measuring the amount of the change between 2013 and 2014, the monetary amounts for 2013 become the base year figures. And calculating change as a percentage, the formula is percentage change is equal to monetary change divided by base year figure times 100%. Using the comparative balance sheets of UD Corporation Ltd. dated December 31, 2014 and 2013, first we should calculate the change of monetary amounts. That would be $12,000 minus $23,500 is equal to $11,500. It is decreased, and $11,500 was the value of our monetary amount. Next, calculating percentage change, that would be $11,500 divided by $23,500 times 100% is equal to 48.9%. That would be the value of percentage change. It is decreased. As you can see, the comparative balance sheets of UD Corporation Ltd., the total assets of year 2014 was $315,000, while year 2013 got $289,700. Therefore, 2014 get the higher amount of total assets than 2013. Okay, let's proceed to the ratios used to gauge asset management efficiency and liquidity on topic 4. The following are the most common ratios to gauge a firm's ability to efficiently manage their assets and measure liquidity or short-term solvency. Receivable turnover. The formula is net sales or net credit sales divided by average receivable. Receivable turnover signifies the number of times the average receivable are collected during the year. It also measures the firm's efficiency in collecting their receivables. Using the report of NEMA Corporation Ltd. Year 2014, we can calculate the accounts receivable turnover. $494,000 would be the sales on account divided by $17,000 is the beginning of year plus $20,000 is the end of year divided by 2 is equal to 18.5. 18.5 is the account receivable. Then $494,000 divided by 18.5 is equal to 26.70 times. Average collection period or number of days in receivables. The formula is 365 days or 360 days divided by receivable turnover. This ratio is very much related to accounts receivable turnover. It indicates the number of days the firm collects its average receivables. It implies the efficiency of the firm in collecting their receivables. Example of number of days in receivable. 365 days divided by 26.70 times, that would be the receivable turnover. I get it from my recent example, is equal to 13.67 days. Merchandise turnover. Formula is cost of goods sold divided by average merchandise inventory. Merchandise turnover suggests the number of times the average inventory was disposed of during the accounting period. It also signifies the over or under investment of the firm in inventory. Finished goods turnover. Formula is cost of goods sold divided by average finished goods inventory. Suggests the number of times the average inventory was disposed of during the accounting period. It also signifies the over or under investment of the firm in their inventory. For example, your sales during the first month are $660, for the second month $600, and during the third month $540. The 660 plus 600 plus 540 is equal to 1,800. 1,800 is your cost of goods sold. Divide your answer by the average inventory you have calculated. For example, 1,800 divided by 300 is equal to 6. Your turnover rate of finished goods is 6. Work in process turnover formula. Cost of goods manufactured divided by average work in process inventory. Work in process turnover signifies the number of times average inventory was reduced during the accounting period. It also indicates the time taken to produce the products. Here's the example of work in process turnover. The Flyaway Bike Company has recently installed a manufacturing resources planning system with advanced shop floor reporting and production scheduling capabilities. It should result in much better control over the production process and reduce the amount of work in process inventory needed. The production manager wants to affirm that the company is receiving the full benefit of this system by measuring the work in process turnover. He collects the information in table for a 4-month period. The manufacturing resources planning system was installed midway through the measured period. The work in process in the month of April was 7.8, in May 7.6, June 8.0, July 8.5. The turnover trend line in the table confirms that the manufacturing resources planning system appears to have gradually increasing the work in process turnover rate. So the production manager decides to continue monitoring this measure over time since there appears to be a declining trend line that may continue into the future. Raw materials turnover formula is raw materials used divided by average raw materials inventory. Raw materials turnover measures the number of times average raw materials inventory was used during the period. It also indicates the sufficiency of the raw materials available. Number of days in inventory. The formula is 365 days or 360 days divided by inventory turnover. It indicates the number of days by which inventories are used or sold. Implies the firm's efficiency in consuming or selling inventories. Here's the example of days in inventory. Anthony wants to know the inventory days of company his and hers. Here are a few details he gathered. The beginning and the ending inventories of the year are $60,000 and $80,000 respectively. The cost of goods sold is $500,000. The year consists of 365 days. We need to find out the days in inventory for Anthony. First, we will calculate the average inventory. The formula to calculate average inventory is average inventory of the year is equal to the beginning inventory plus the ending inventory divided by 2. That would be $60,000 plus $80,000 divided by 2. 60 plus 80 is $140,000 divided by 2 is equal to $70,000. The formula will be inventory turnover ratio is equal to cost of goods sold divided by average inventory. That would be $500,000 divided by $70,000 is equal to 7 times. Therefore, the inventory days would be 365 divided by 7 is equal to 52 days. It is the number of days in inventory. Working capital turnover. The formula is net sales divided by average working capital. It signifies the pace by which working capital is used. It also indicates the adequacy of working capital in the firm's operations. For example, say that company A has $12 million in net sales over the previous 12 months. The average working capital during that period was $2 million. The working capital turnover ratio is $12 million divided by $2 million is equal to 6. This means that every dollar of working capital produces $6 in revenue. Current asset turnover. The formula is net sales divided by average current assets. It signifies the phase by which current assets are used. It also indicates the adequacy of current assets in the firm's operations. We use the income statement and balance sheet of Company A to calculate the current asset turnover. Current asset turnover of year 1 is 3,351 divided by 656 is equal to 5.10. The current asset turnover of year 2 is 3,854 divided by 766 is equal to 5.3. Year 2 witnessed a slight decrease of firm's current asset turnover ratio from 5.10 to 5.3 comparing to year 1. This indicates a slight decline in firm's ability of generating sales through its current assets, such as cash, inventory, accounts receivable, and etc. In other words, in year 1, firm generated 5.10 on sales for every current assets dollar. In year 2, it started generating 5.3 times as much sales as its current assets. Payable turnover. The formula is net credit purchases or net purchases over accounts payable. It signifies the firm's ability to pay trade payables. It also measures the number of times the amount of average payables is paid during the accounting period. I prepare a short video clip to better understand the payable turnover.
The accounts payable turnover ratio measures the speed at which a company pays its suppliers. The ratio is calculated by dividing a company's total purchases from suppliers by its average accounts payable amount over the same period. Suppose XYZ Corporation buys $100 million worth of supplies in a year, and at any given point holds an average accounts payable of $20 million. Its accounts payable turnover ratio is 5, meaning XYZ pays its average accounts payable 5 times over the period of time. The ratio can reveal more than just the speed at which a company pays its bills. A high or increasing ratio means the company is paying off its suppliers quickly. Investors may like that, but it may also mean the company is missing out on opportunities to use its money for other endeavors, such as projects that could generate more returns. If the ratio is low, it can mean the company is struggling to pay its suppliers. If the ratio is declining, the company is taking longer to pay suppliers, which may reveal a troubling financial condition.
Operating cycle in trading concern. Formula is days sales and merchandise inventory plus number of days to collect receivables. Operating cycle measures the length of time in order to convert cash to inventory to receivables and back to cash. Operating cycle in manufacturing concern. The formula is number of days usage and raw materials inventory plus number of days in production process plus number of days sales and finished goods inventory plus number of days to collect receivables divided by average cash balance. Operating cycle in manufacturing concern measures the length of time in order to convert cash to raw materials inventory to work in process to finished goods inventory to receivables and back to cash. Operating cycle of a manufacturing concern starts from cash to purchase of raw materials, conversion of work in progress into finished goods, conversion of finished goods into bills receivable, and conversion of bills receivable into cash. In the other words, the operating cycle is the number of days from cash to inventory to accounts receivable back to cash. This cycle provides an insight of the operating efficiency of the company. Days cash. The formula is cash operating cost divided by 365 days or 360 days. Days cash indicates the ability of the firm's cash to pay the average daily cash obligations. For example, Jane works in a software development firm as a programmer. Due to the COVID-19 outbreak, all staff are mandated to stay and work from home. Because of the economic shutdown, no funds are coming in and the company is not making any sales. Her manager decides to calculate the day's cash on hand to find out how long the company could operate without taking on any debt. Here are the statistics he found. The company had $90 million in cash and cash equivalents available. It also had operating expenses of $450 million and a total of $80 million non-cash or depreciation expenses. Now, let's use our formula. Days cash on hand is equal to 90 divided by 450 minus 80 divided by 365 is equal to 88.7. In this case, the days cash on hand would be 88.7. This means that Jane's firm has 88 days cash on hand and can operate without profits for 3 months before going bankrupt. This number is amazing because it gives that business time to plan a way to serve customers or get a loan and raise more money. Asset turnover, the formula is net sales divided by average total assets. Asset turnover indicates the firm's ability to efficiently manage their assets to generate revenue. Anything tangible or intangible that is capable of being owned or controlled to produce value and that is held to have positive economic value is considered an asset. Companies with low profit margins tend to have high asset turnover while those with high profit margins have low asset turnover. Fixed asset turnover or property, plant and equipment turnover. The formula is net sales divided by average PPE or property, plant and equipment assets. This indicates the firm's ability to efficiently manage their PPEs to generate revenue. The higher the ratio, the better, because a high ratio indicates the business has less money tied up in fixed assets for each unit of currency of sales revenue. A declining ratio may indicate that the business is overinvested in plant, equipment, or other fixed assets. Fixed assets, also known as a non-current asset or as a property, plant, and equipment, is a term used in accounting for assets and property that cannot easily be converted into cash. And for the conclusion, asset management ratios are necessary for the evaluation of the efficiency and effectiveness of a company. These ratios indicate how well a company uses its assets in generating revenues. The purpose of these ratios depends on the user. Asset management ratios are of significant importance, although they have some limitations.
Good day, sir. My name is Jubilee D. Monterde from BSBA 2H. So, ang topic pong na-assign sa akin is topic 3, comparative balance sheet at comparative income statement. So, comparative balance sheet is a statement that shows the financial position of an organization over different period which comparison is made or required.
Sa in preparing a comparative balance sheet, the items are placed in rows and years. Also, the amount are shown in the columns. So, amount are shown in columns. Ito ay yung example ng comparative balance sheet. Meron silang previous year and current year. So, share capital. Nung previous year is 100,000 and then nung current year is 100,000 pa rin. So, hindi tumaas yung share capitals nila. And then, for the reserve and surplus, nung previous year, 20,000. And then, nung current year, 25,000. So, tumaas siya ng 5,000. Nitong current year. And for non-current liabilities, long-term borrowings. So, nung previous year, nag-borrowed sila ng money na 35,000 and then bumaba na yung borrowing money nila ng 30,000 which is nag-less ng 5,000. So, ibig sabihin, kumita sila. And then, for trade payables, 40,000 yung previous year. And then, nung current year is 45,000. Bakit? Tumaas ng 5,000 ang payables na. Ibig sabihin, dumagdag yung expenses. Kaya, dumagdag din yung current year. And then, the short-term borrowings, dati, previous year is 9,500. And then, yung current year, 10,000. Tumaas ng 5,000 ulit yung borrowings nila. Ganun lang. Dito tayo sa comparative income statement. Nakalagay dito is, comparative income statement combine information from several income statement as a column in a single statement. So, it helps you to identify financial trend and measure performance over time. So, in basic words, comparative income statement is for financial performance. So, detalyado yung income statement compared dun sa comparative balance sheet. Kasi sa comparative balance sheet, nakalagay lang dun is yung year 2018 and 2017. But the income statement is, nakalagay dito is percentage and the amount. So, ibig sabihin detalyado. So, ang sales ng 2006 is, the percentage is 100 and the amount is 500. And nung 2007 na siya, the percentage is 100 and the amount is 600. So, tumaas yung nung 2007. Ibig sabihin, kumita yung sales. And then, the less cost of goods sold nung 2006 is 55%. And then, yung amount is 275,000. And the 2007, 64% and 385,000. So, tumaas yung less cost of goods sold. Ibig sabihin, kumita ulit. And then for the gross profit, the 2006 is 45% and the amount is 225,000. Nung 2007 naman, 36% and the amount is 218,000. So, tumaas yung gross profit nitong 2007. Ganun lang, hanggang sa matapos ka sa net income.
So, number 1, ratio, rate of return on sales on or net profit ratio or net profit margin. So, ang kanyang formula po is net income divided by net sales. So, ang kanyang significance is measures the amount of the net income per peso of sales. It also shows the proportion of the net income to the firm's sales revenue. So, number 2, rate of the return to total assets. So, ang kanyang formula po is return on sales times asset turnover or net income divided by average total assets. So, ang kanya pong significance is measures the company's profitability in using their total assets. It indicates the net income generated by using the firm's total assets. Signifies management efficiency in using their assets to earn income. So, number 3, assets turnover. So, ang kanya pong formula is net sales divided by average total assets. So, ang kanya pong significance is signifies management efficiency in using their assets to generate sales revenue. So, ang number 4 po is gross profit ratio. So, ang kanyang formula is gross profit divided by net sales. So, ang kanyang significance is measures the gross profit per peso of sales revenue. So, this is important in sustaining the adequacy of gross profit to meet operating expenses plus their desired profit. So, the number 5 is operating ratio. So, ang kanyang significance is operating income divided by net sales. So, ang kanyang significance po is measures the proportion of sales revenue used to cover operating costs. So, number 6, cash flow margin. So, ang kanyang formula po is cash flow from operating activities divided by net sales. So, ang kanyang significance is indicates the firm's ability to translate the sales into cash. So, 7, rate of return on current assets or working capital. So, the formula is net income divided by average current assets. So, ang kanyang significance po is management efficiency in using current assets to generate net income. The number 8, sir, is rate of return net working capital. So, ang kanya pong formula is net income divided by average net working capital. So, the significance is measures management efficiency in using net working capitals to generate revenues. So, the number 9 is rate of return owner's equity. So, the formula is net income divided by net average owner's equity. So, ang kanyang significance is indicates the amount of return per peso of owner's equity. So, management efficiency is using its invested capital to generate revenue. So, the number 10 is earning per share. So, ang kanyang formula is net income preference share divided requirement or divided by number of ordinary shares outstanding. So, ang kanyang significance is measures the peso return on each ordinary shares issues. So, signifies the firm's ability to pay dividends. So, the number 11 is price earning ratio. So, the formula is market price per share divided by earnings per share. So, the formula is indicates the relationship between the market price of ordinary shares and the earnings of each ordinary share. So, the number 12 is earning price ratio or capitalization rate. The formula is earning per peso divided by market price per share. So, the significance is measures the rate at which the share market is capitalizing the value of current earnings. So, the number 13 is dividend per share. The formula is dividends paid or declared divided by ordinary shares outstanding. So, the significance is indicates the earnings distributed to the owners on a fair share basis. So, the number 14 is payout ratio or dividends payout. So, the formula is dividends per share, earnings per share. So, the formula is measures the percentage of the company's earning paid to owners.
Good day, sir. I'm Erica Onates, BSBA OM2H. My report about common size statement and trade analysis. Common size statement, also known as vertical analysis. Vertical analysis is a method of the analyzing financial statement that lists each line item as a percentage of a base figure within a statement. The first line of the statement always shows the base figure at 100% with each following line item, representing a percentage of the whole. Example of common size statement. The common size percentage are calculated to show each line item as the percentage of the standard figure or revenue. Tried analysis, also known as pyramid method. In the word pyramid method is a manual method of summarization, evaluation, and it was developed in a tap to address a key problem in summarization, namely the fact that different humans choose different content when writing summaries. Example of tried analysis. The tried analysis, examining sales pattern to see if sales are declining because of a specific customer or product or sales region. Examining expenses report claim for proof of fraudulent claims for case revenue and expenses line item into the future of budgeting for estimating future results.
Good day, sir. My name is Normelin Orsus from Base Bay OM2H. Lesson 3. Financial Statement, the Ratio and the Analysis, the Inflation to Management. Ang ratio analysis daw po ay ang pagsasaguri ng ratio ay nagpapahambing ng mga line item sa financial statement ng isang negosyo. Cash flow analysis. The cash flow will record of company and flow and cut flow of actual cash, cash and cash equivalents. The fund flow records the movement of cash in the out of the company. Both help provide investor and market with a snapshot of how company is. Account receivable. The account receivable is the balance of money due to a firm for good or service, delivery of use, but not yet paid for by customer. Account receivable are listed on the balance sheet as current assets is any amount of money owned by customer for purchase made of credits. For inventory, the inventory, through the process of site inventory analysis, you can determine elements of condition that will impact the ultimate use design. If your landscape design, when based truthful inventory analysis, can improve the environment by creating new features based on user hands and keep those features are demand useful and desirable